Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with co-host Walter Dial. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that is transferable and then help you exit successfully. As a successful business owner, you have massive impact. If you've listened to us at all, you've heard us say that over and over. Impact for your family, your customers, your employees, their families, the economy, the community in which you do business. All of those stakeholders and others benefit from your products, your services, your financial performance, business operations, and just success overall. And oftentimes they benefit directly from your generosity. We've seen this time and time again. You often invest in your communities through your charitable or philanthropic activities and giving. And so that's what we want to talk about today. And specifically, donor advised funds, private foundations, they're charitable giving vehicles that can help you minimize taxes during a sale or transfer of your business, while at the same time helping and supporting your philanthropic goals, whatever they might be. However, at the same time, it can be very helpful, but it's critical that you understand the timing of gifts of stock to these vehicles. Your business entity type comes into play, of course, and then the IRS rules. And so you need to understand all of it. It's critical that you do in order to avoid recharacterization as taxable income. And so today's topic is utilizing donor advised funds and private foundations when selling or transferring your business. And we're excited about our guest, who Walter is now going to introduce as one of his former colleagues.
Yeah, our guest today is Lisa Heller. Lisa's a principal in the nonprofit tax department at GRF CPAs in Bethesda, Maryland. That's my old firm. And she has over 25 years of experience working with tax-exempt organizations. Over the course of her career, she's helped countless exempt organizations with their tax compliance and advisory needs. She's worked with hospitals, healthcare organizations, research associations, private schools, social welfare organizations, membership and trade associations, public charities, and private foundations. That covers every type of possible nonprofit. Lisa's also worked with owners of small to mid-sized businesses, helping them with what we're going to be discussing today. She's past chair of the Greater Washington Society of CPAs Nonprofit Symposium, and she serves as vice chair of the AICPA Exempt Organization Tax Technical Resource Panel. So Lisa is certainly very knowledgeable and an expert, but just keep in mind, on these podcasts, nothing that she says or anything Pat or I says is to be considered, tax advice for you. These are just general strategies which you always need to run through your own tax professional. Lisa, welcome to the podcast. Great to see you.
Thanks for having me.
So I think this could be a great topic. But let me start off with just one clarifying point. So as Pat said, our topic is using donor advised funds and private foundations. And going forward in our conversation, when we say private foundations, we're just going to be referring to a non-operating private foundation. But there are operating private foundations, which I think, it's important, at least for our listeners, to just get a very basic understanding of. So can you just explain to us what is a private foundation and the distinction between an operating and a non-operating private foundation?
Absolutely. And thank you, Walter and Pat, for having me today. And that's a great question to kick us off with. A private foundation is a charitable organization. It's been recognized by IRS as charitable under Section 501c3, and contributions to it are tax deductible to the fullest extent otherwise, allowed in the tax law. A private foundation in general differs from a public charity in that it is not publicly supported. Typically, it's closely held or closely supported by a single family or a single company or otherwise does not have a broad base of public support. And in fact, private foundation is the default classification for Section 501c3 charitable organizations, unless they can demonstrate that broad base of public support, and then they become a public charity. So that's your top level. What is a private foundation? A private non-operating foundation is kind of your mental image of a private foundation. When people use that term, private foundations, generally they're referring to a non-operating foundation. And that's one that is generally philanthropic in nature. They exist to receive contributions from their sources, and then they turn around and they gift those out as grants to other public charities. So they really are grant-making organizations at their core. And in fact, they're required by IRS to gift out a certain percentage of the value of their net assets every year to stay in IRS's good graces and try to avoid other penalties. A private operating foundation is a subset of private foundation that operates more like what you might picture as a charity. So they engage generally in direct charitable activities instead of just grant making, writing checks or other gifts to charities. And sometimes you'll see, like private museums or private libraries, or very, very often it's artistic organizations that fall into the non-op or the operating foundation category, but not always. And it has to do with what the activities the foundation conducts. And generally you need a special designation from IRS to be classified that way.
Okay, great. That made a lot of sense. I think that clarified that for a lot of people. So just walk us through, let's say I've got a bunch of money. I want to start a private foundation. Tell me what I have to do to get it set up, what I have to do to stay in compliance with the IRS going forward, and kind of, how big do you think you need to be to make it make sense, and how expensive is the whole process to set up and to keep going?
That's another great question. So if you have it in your mind, you want to establish a private foundation as a giving vehicle, and it can be a good tax planning tool for you, depending on what your situation is. That would be a separate legal entity that's incorporated under the nonprofit statute of a state or the District of Columbia. So you would need to formally establish your foundation by incorporating. You would want to get bylaws. You would need officers, and different states require a certain number of officers. So there's the organization part, and the articles of incorporation must contain certain language that IRS wants to see to qualify you as a charity under Section 501c3. So competent counsel is very important from step one. You would need to register for a separate employer ID number. Then after that's all done, you would apply to IRS, send in an application on Form 1023, generally Form 1023, where you apply for recognition of tax-exempt status with IRS. That carries a user fee right now of $600, in addition to any professional fees you might incur in preparing this application. It's a pretty robust application. Actually, it's not just like a one-page electronic thing that you can dash off in a minute or two. Certainly, if you want to get it correct, you file that, you get your determination letter, and then there's the ongoing operations of the foundation. So you would need your operating board, right? You would need to do whatever it is to get your giving vehicle in place. And then you also have to file annual tax returns with IRS on Form 990-PF. And that filing requirement is there regardless of the size of your foundation. If you don't file your 990-PF 3 years in a row, IRS will automatically revoke your tax-exempt status. Plus, there are penalties for not filing the return on time. So there's a lot of compliance and maintenance that's needed. Like with any other business, really, a private foundation is a separate business that needs to be fed and watered and cared for it to continue. Now, in terms of what the threshold would be, there's no bright line test. There's no requirement for how much you need to contribute to a private foundation to get it started. But I would say, just given all the work that's involved in setting it up and keeping it going, if you're not giving a minimum of $5 million, I would not think the juice is worth the squeeze personally. But other tax professionals may have other thresholds in mind. I've seen them much smaller. Again, it's a lot of work for such a small foundation. I've also seen them significantly larger, and there are private foundations whose name you probably know, who are this exact corporate form and do these exact things.
Yeah, and so the work, the ongoing work, the ongoing compliance, and any fees that are involved with that, Lisa, play into. Tell me if this is right. The it seems the reality that donor advised funds have become so popular over the last, I don't know, 20 years or so, because you can accomplish so much with the DAF that you can accomplish with the private foundation, but you don't have the ongoing compliance. The DAF is responsible for all of that.
That's right, Pat.
Yeah. So you want to just take a moment or two and kind of differentiate between those two vehicles, however you might do that.
So certainly, I mean, I just discussed what's needed to, set up and maintain a private foundation. A donor advised fund is much simpler than that. A donor advised fund is also tax exempt under Section 501c3. They tend to be public charities rather than private foundations, and the fund itself is run by a sponsoring organization. So if you, the business owner, choose to donate to a donor advised fund, your contribution to the fund will be deductible in the year that you donate. The deduction thresholds are higher for donating to a public charity. If you run into, you're very philanthropic and you're giving a significant chunk of your income in a given year, it's limited to generally 60% if you're giving cash to a donor advised fund, where it's 30% if you're given to a private foundation. But that's really getting into the weeds here. A donor advised fund is administered by this other organization, the sponsoring organizations. You will see quite large brokerage houses that can manage these, like a Fidelity, a Vanguard, or Schwab. And then there are other smaller charitable organizations, community funds of all stripes, that also can manage donor advised funds. So once you put the money into the donor advised fund as a donor advisor, you would then direct the donor advised fund to distribute those funds to charities as you see fit. And because the money technically belongs to the sponsoring organization now, the charity, it's not yours anymore to donate, but you can advise them where to put it. So, but there's a lot less administrative hassle, I'll say, on the donor advised fund side. You don't have to do annual filings. You don't have a distribution requirement on your end. And in fact, donor advised funds are not required at all to distribute any of their money to charity. Although I believe in general, donor advisors are pretty good at remembering to do that. And also the sponsoring organizations are pretty good at reminding the donor advisors to make distributions from time to time, because that's really a point of contributing to these charities, is not to grow the funds over at donor advised, at Vanguard or Fidelity or whatever, but ultimately to get that money into the hands of deserving working charities.
Mm-hmm. Okay. So let's say Walter owns a business, and we've been working with Walter for the last few years, and he wants to exit. He wants to sell his business in the next 2 or 3 years. And we're still working on, is he going to do a third-party sale, or is he going to do the sale to insiders? We're not sure on what he's going to do there yet, but he is going to sell it. And he's philanthropic. Walter's charitable. He's got some ongoing commitments to 2 or 3 charities, and he's thinking, oh boy, once I sell this business and get this big slug of money, I'm going to give these charities some more money. And we say, well, there's other ways to do that might be more advantageous to you from a tax perspective during the transaction. You might want to you should consider setting up with your tax professionals, either a DAF or a private foundation and move shares, appreciated shares, into that vehicle prior to the transaction so that you can avoid some tax. When we do that with Walter, how would you decide or help Walter decide whether or not he should use the DAF or the private foundation for that particular strategy?
That's a great question. And I believe that a number of small business owners think about this, as they're moving into their next stage. You hope when you set up a business that you'll, a family business, that the family will continue on. And maybe they do, but maybe they don't, right? That really just depends on the dynamic of the family and the success of the business and many other factors that I really am not well schooled to talk about in that way. But the tax perspective, if you already have a family foundation and you may feel like you want to support it, that may play into your decision, even though it may not be the most advantageous way tax-wise. And so that's a decision you have to make also. If you're donating the stock to the private foundation as a way to be charitable, certainly if you sell your shares, right, you sell the business, you will probably have a capital gain if you've had it for a while, and you've got to pay tax on that. And then you have a pile of money to donate either to the PF or the DAF. And that's not the question that you asked, and I know that. If you choose, though, to donate the stock to the charitable vehicle, and you donate it to the private foundation, the tax law says that you're limited to your basis in those shares. So you don't get the benefit of the appreciation in those shares over time. Really, it's the lower of the basis of the fair market value. And I would hope in your case it would be the basis. That's the lower amount. If you donate those appreciated shares to a DAF, you are allowed to deduct the fair market value of those shares at the date of the contribution. So clearly there's a huge benefit to that. It's a very old benefit. In fact, there's a movie, The Philadelphia Story, where that very you familiar with that movie? Paul Newman plays the accountant who gets the corner office because he gives that exact advice to somebody. But I digress. I had to get in a movie thing in this podcast. I just did. But you do get the benefit of deducting the fair market value of your shares if you donate them to a DAF. You would want to make sure that the DAF can accept those closely held shares. Private foundations have more flexibility into the types of assets that they can accept and that they can hold and use. So I believe that the larger shops do take them. But again, you're going to want to talk to your tax advisor and you're going to want to talk to your investment advisor to make sure that this makes practical sense, even though to me it makes great tax sense to do that should the situation arise.
Yeah, at this point, our experience with Fidelity Charitable Gift Fund, which is huge. I used to work for Fidelity, and some of the other Schwab and Vanguard. I think does Vanguard have a DAF, Walter? Do you know? Yeah. They've gotten really good about taking special assets over the last 20 years or so. So, okay. Is there anything else you would say to business owners as they're considering one or, is there ever a situation where you've seen an owner or someone have both private foundation and a DAF? Is there any kind of reason to do that?
I mean, sometimes you will see a business owner have both a private foundation and a donor advised fund because the private foundation is older and it's been established. And then remember, donor advised funds have actually been around for quite some time, but they were codified into the tax law in 2006 as part of the Pension Protection Act. And it was around that time that they really started to take off. I believe that Fidelity had their donor advised fund in place before that, but they really ramped it up after the tax law was
I think
passed.
it was the mid-90s. I think it was the mid-90s. I was there in the mid-90s, and I think it was around that time that Fidelity rolled out its charitable gift.
Right. I mean, I have not. I mean, I have seen situations in which people will set up private foundations and instead of putting the money into a donor advised fund, and some of that is just a personal preference. Like they just something that really has nothing to do with knowledge of the law. It's just that they believe that that's what they should do. And that's fine. The vehicles do both exist. They're both great charitable vehicles. Some of them actually like the fact that private foundations do have a minimum distribution requirement each year, that they feel like that's that reminder that they get from their accountant, or that they just know that they have to give the money to charity. Whereas if you put money in a donor advised fund, I mean, you really literally could sit there and you take your deduction in year one, and then the money just sits and it grows, and you're supposed to donate out of it. You're supposed to advise the fund to donate, but there's no penalty if you don't. And I know DAFs have gotten some bad press about that over the years. And there's nothing in the tax regulations right now that says that they have to make those distributions. And that doesn't sit so well with some people. Like, they would just prefer that structure
Yeah.
involved.
Hey, Lisa, let me ask you, I'm just trying to put myself in the shoes of some business owners who are listening. So I kind of have four points, some of which I'm going to ask you to comment on. So one is, and you don't need to comment on this one, but just so everyone is aware, oftentimes, let's say somebody sells their business for millions of dollars, and, they don't want to give millions to charity, but maybe they currently give $20,000 a year to their church. It could make sense. Go ahead and set up a donor advised fund, put a couple $100,000 into it, and then make your $20,000 a year contribution for the next 10 years out of it. So it's a way, even if you don't really want to give a whole bunch of money to charity, maybe from a timing standpoint, the DAF offers you the ability to put a lump of money to get the tax deduction matched in the same year as you have the income. So that's something people should be aware of. Something else which Pat just kind of hit on, which I think people need to be aware of. You can't put your money in. You can't say, well, I think I'd really like to do a private foundation, but it's late in the year and I'm not going to have time. So I'll go ahead and park the money in a donor advised fund, then do the private foundation. They need to be aware you can't, once the money's in the DAF, it needs to go to a public charity. It cannot go to your own private foundation. And then one last point I'm going to make, sorry for dominating, then I'm going to ask you a question. So my last point is, I have had clients, wealthy clients with adult children, and they know that they're, like I had a client who sold a business for hundreds of millions of dollars. So he knows at some point his kids are going to inherit this money. And he does have some charitable intent. So his theory, which I think was solid reasoning, was he opened up a private foundation, made his kids active members, and he used it as kind of a training ground for helping them to understand, how this money's managed by the wealth manager and things like that. So that when they end up inheriting a bunch of money, it's not going to be like a shock to them. They'll have had years of learning about how it's invested, how the market works, and how the charity works. So I thought that, that made sense to me. So here's my question for you. People who aren't really familiar with the rules surrounding private foundations might think, well, I can set up a private foundation, I can pay myself a salary and the kids a salary, so I'm kind of getting this tax deduction, but I'm still able to benefit my family. Can you kind of talk about how the IRS looks at that?
That's a great question. There are definitely rules and requirements as to what private foundations can and can't do with respect to their activities. They are charitable. So any assets in the foundation are required to be used for charitable purposes, either direct grants, right, or conducting charitable activities, or administrative activities that support the functioning of the foundation. You've got some of these foundations, they have a separate office. You've got to be able to keep the lights on. You've got to be able to pay your people, and other expenses that are incurred in support of these activities. But those expenses all must be reasonable, at arm's length relative to what you are getting in return. So if you are setting up a foundation for the purpose of finding a way for getting your contributions back to you and like washing it in the form of a salary to you or your kids, You can only do that if you're performing services for the foundation that are commensurate with what you're getting paid. And then, of course, there's all the payroll tax rules that you have to deal with also, right? You'd set yourself up as a W-2 employee with tax withholdings, but that's the least of it. Salaries must be reasonable. Compensation, especially to founders and board members and family members. Those are called disqualified persons, which is kind of a scary term, but that's the term that IRS uses to describe people who are closely connected with the foundation's founding and general operations. Any compensation derived by them must be reasonable, and it's always better if you look at comparable statistics to make sure that salaries are not too high, and if there are penalties that IRS imposes attendant to that. And if it's really bad, you could lose your tax exemption. So you really just be careful when it comes to that strategy.
Yeah, would you? Is it a good idea? It seems like it would be to have written job descriptions for those roles.
Absolutely. It's always a good idea for any business to have a job description, especially for your top people, including, what are the roles and responsibilities for each person. An organizational chart is helpful, not just for your board, but also just for the employees and who might report into whom. Some foundations are quite large and they're staffed with a lot of people. And some of these people might earn a lot of money, but those salaries are supported by comparability studies. Sometimes you get a third-party consultant to help you with a salary survey, or there's other publicly available information that can help you make those determinations. But also a salary range is very helpful.
Okay, so Lisa, we'll ask you for any closing thoughts or comments, words of wisdom here in a minute. But one more question that I have, maybe for both of you, just to help listeners with the timing issue. Let's say they get it. They're thinking, yeah, you know what? I'm going to be going to closing. I'm going to close on my business. It's scheduled in September 15th. I'll set an appointment with my estate planning attorney on September 12th and set up one of these DAFs or one of these private foundations and move my shares in there a couple days before I go to closing. Can I do that?
When you say closing, Pat, you mean selling for
Close on
cash?
a sale transaction of the business.
Right. Well, I mean, let's talk about private foundations first, because that is a more complex structure in terms of how you would maintain it. You don't need your determination letter from IRS to consider it a tax exempt organization. Once you have organized on that date of organization, you can operate under the presumption that IRS will grant your tax exempt status. So what you're limited by really is your ability to set up an account such that you can make a contribution to the private foundation. It's best to have your organizing documents in place first. So maybe the rate limiting step is getting an appointment with an attorney who can help you incorporate and get those filed. And then, setting up a bank account, a business bank account, usually takes same day if you're with the correct bank.
Yeah,
So,
Lisa, my question is more along the lines of moving the actual moving of the shares of the company that I'm going to sell in a couple of days into that vehicle.
yeah, I mean, it would be quicker with a donor advised fund, certainly, I believe, than with a private foundation, especially if you're setting up something new. Also talk to your tax advisor about just timing of this, especially with the new tax laws that were passed last month. There are new ceilings on charitable contributions. There are new floors on charitable contributions that for individuals that didn't exist before. So it may make sense to, like Walter referred to before, front load those contributions in a given year, or maybe plan out 2 or 3 years in advance and make your, get the deduction in the year that would make most advantageous sense to you, and then pay out the money to the charity in the time that you wish, ultimately through the vehicle. So did that answer your question, Pat?
Well, I think that actually answered a question I was going to ask. So I appreciate that. I think what Pat is getting at, and it's really, kind of a gray area, is how far along in the sale process can you be and still make a contribution? of your stock. In other words, at some point, it's kind of like you've got the sale, so you can't transfer it at a certain point. And different lawyers, and this is, you got to talk to whoever your transaction lawyer or state lawyer is, but different lawyers have different theories. I mean, I have one lawyer who we used to work with who his theory was, until you have sat down at the settlement table and have signed final documents, you could do that. You could transfer your stock 5 minutes before them. A lot of other people say once you have an LOI, the more conservative people would say once you have an LOI, you're done. You can't do it anymore. And then a lot of people
I don't have an opinion one way or another. I would have to rely on transaction. I would have to rely on transaction counsel for that advice. However, I can tell you that if when it's okay to pull the trigger and it's okay to make that contribution, assuming you're contributing more than $5,000 of shares to your vehicle, get yourself a qualified appraisal. Because that's the necessary documentation for you for your tax return.
Yeah.
But in terms of actual timing of when you're allowed to do it, that's I mean, that I'm really not qualified to make that decision. That's not in my wheelhouse, but I'm sure there's very competent counsel, and maybe you all can help with that too.
Yeah. So again, a key message here with these, with either one of these vehicles is make sure you get the right counsel to help you make these decisions. Okay, Lisa, fantastic conversation, great content, very helpful. I know the owners who are listening are going to benefit greatly from it. Any last words of wisdom or anything else that you would say? Was there a question that we should have asked that we didn't? Anything that you would say here at the end as we close?
Well, thank you for your time, and I think this was a great conversation. I hope the viewers are getting a little something out of it today. I highly encourage charitable giving. Everybody has their own threshold for how philanthropic they would like to be. But there's definitely some restrictions in the tax law, certainly, to charitable giving, but there's also some advantages if you structure it correctly. So when you are ready, if you're ready to make such a move to do this for charity, I know the charitable organizations would greatly appreciate the additional help, especially now where federal funding is so iffy. And private foundations and DAFs are really stepping up to fill in that gap, which is wonderful. So for me, and as a nonprofit specialist, I would say there's no time like the present in terms of giving. But of course, you have to consider your own situation. But please do speak with your tax advisor to help you structure your gifting in a way that makes most sense for you and accomplishes the purposes that you want. It's not just for tax advantage. It's to make sure that charities that you care about and charitable purposes that you care about are being benefited. And there's many, many ways to do that.
Hey, Pat, can I just say one thing before you close us out?
Yep.
And we talk about this a lot. Just like you don't want your brother-in-law who handled your divorce to be your transaction attorney. Nonprofit tax is an incredibly specialized field. I mean, it's always, I was in for-profit tax, and it always blew me away that the rules regarding nonprofit tax are probably more complicated than for-profit tax. And I'm always like, they don't even pay tax. Why are these rules so complicated? But it is, and there's so many ways to go astray. And when you do, the penalties are astronomical. So my point is, don't assume that your current CPA, who might be the world's best CPA, knows anything about nonprofits. And, if they're good, they're going to tell you you need to talk to somebody. And
tax exemption is not a right. It's a privilege. And with privilege comes responsibility to apologize to Stan Lee there a little bit. But absolutely right. And thank you for that. It's very, very important that you get proper counsel when it comes to not just your own tax advice, but you may need somebody different to help you if you've got a private foundation, right, to run those private foundation tax returns, because there's a lot of mistakes you can make on Form 990 PF, and it's deceptively simple looking, that form. And if you answer specific questions incorrectly, IRS may come calling, and you really want to avoid that if you can.
Yep. That was all I wanted to say.
Okay, good. All right, so Lisa, is there anything we'd like to ask guests if there's anything they want to promote here at the close, and if there's anything you'd like to promote, and or if you'd like to provide your contact information for anyone who would like to reach out.
Absolutely. So thank you for that. So I am a principal in the nonprofit tax team with GRF CPAs in Bethesda, Maryland. That is Walter's former firm as well. We specialize in audit, tax, outsourced accounting. Pretty much all of your accounting needs we could assist with. Nonprofit specialty certainly, but also for-profit tax. So we have a robust individual and small business tax practice as well. So if you're looking for someone to help you with those accounting needs, certainly I would be happy to forward you to the correct person in that regard. And yes, feel free to share my contact information, and I appreciate the opportunity.
Excellent. All right. Thanks, Lisa. It's been a great conversation. You've been a wonderful guest. And listeners, excuse me, if you want help in maximizing the value of your business, the transferability, the sellability of your business, or planning for that eventual exit, you don't know what to do. Our clients come to us, they know they want to leave, they just don't know how they want to do it. If any of that's true for you, contact us, please. Ennis Legacy Partners through our website, ennislp.com or exitreadiness.com. Either one of those work. Thank you again for listening. If you've benefited from today's episode, which I'm sure you have, please consider liking it and sharing it all over your social media, and subscribing, please, if you've yet to do that. Until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial is signing off.